Hello everyone, welcome back to my channel. I know it's been a lot of time since I have posted, so today we'll be talking about quantitative finance. Specifically, we'll talk about what alpha is and how are different mathematical models revolving around alpha. So just for your information, I am a research consultant at WorldQuant, which is a quantitative research hedge fund, and what we do is we generate alphas in fast expression language and we submit them to the WorldQuant team, and then based on that the financial strategies are prepared to trade the markets. So I think the first thing we should talk about is what exactly is a alpha, beta, these kind of things. So so just informing you guys that I'm from a social science background. There might be some things that I don't get very good that the people from technical background might get, but I'll try to explain my best. So beta is essentially the market as a whole. So suppose if we consider the Indian stock market, let's say Nifty 50 is the beta. That's a whole market of all the stocks that trade in Nifty, or if we can consider that NSE as a whole. So I think that is a beta, and the alpha is how much exceeding returns that you are generating from the beta. So suppose if Nifty 50 returns an annual return of around 8% and you are having a return of 10%, so you are beating the beta by alpha of 2%. So that's how we submit the alpha. Now we'll talk about how do we create an alpha, what are the methodologies that are behind creation of an alpha. So I think initially if you're starting out quants or quantitative finance, it's more about understanding the concepts rather than doing the mathematical modeling or statistical modeling. So for this I think we'll go through few hypotheses. So generating an alpha is majorly about hypothesis. So based on whatever knowledge you have about finance, financial markets or stock market, you create a hypothesis. This can be a very simple hypothesis that you can naturally observe, but those things are like very obvious, and then that's why they don't work, right? So just for the explanation, suppose I have this hypothesis that when a dividend is announced, the stock prices will rise, and right after the dividend is given, the stock prices will fall because people will get the dividend and then they'll start selling that. So this is the hypothesis. Now once you're done with the hypothesis, then you do the back testing to validify your hypothesis. So for that, I don't know about the Indian context that much because we trade in the international markets. So we have a large database of, I don't know, like thousands of GBs, thousands of data files and all. And we generally trade on the US and European markets. But if you want to do the back testing on Indian markets, you can use Zerodha Kite API for that purpose, and then you can create your own model on Python and then do the back testing and all using whatever hypothesis you have. Once you have done the back testing, you will find certain returns. How, like suppose if you have allocated 1 CR capital to any strategy of yours, so at the end of the duration of your trade, what is the leftover? How much did you make from that trade? Now it might be there that your strategy has made significant returns, like out of 1 CR you generated like, let's say 5% in 6 months, right? That's a very good return. So you will say that this is a good strategy, you will start trading like that. But I think that might be not okay with if you are having a lot of capital, because it increases the risk. The more capital you have, the more you have the risk, right? You won't bother losing like 1,000 rupees, but you will obviously bother losing 10 lakh rupees. So that's why these hedge funds, they don't just test the returns. We also test that does this strategy works consistently, right? What are the drawdowns? What are the like, how do I say this? Like, what are the extreme values of this strategy? How much it can go up, how much it can go down. So for this, we test the Sharpe ratio of the strategy. What Sharpe ratio does it tells us about how good the returns are being produced consistently. So suppose if you have a return of around 10% from a like strategy that is like going zigzag, right? You invested at like 1 cr, it went to 15 cr. That's very hypothetical, it's not possible, but it went to 15 cr, so 15x returns, right? Similarly, there's a strategy which did only 10x, but it's consistent. So, which strategy will you trade on? A hedge fund will trade on the consistent strategy, because since we have so much to lose, we have billion and trillions of dollars that we are managing, the assets under management. You can't bother to lose like billions of dollars just for the sake of like $2-3 billion more, right? So that's why Sharpe ratio becomes important. Now coming back to the hypotheses that are usually considered and the various models that are prepared, I'll talk about a few and then we'll just over the video, because it will be too much of information. This is just an introductory video. So there is this one method that we use in trading that is called mean reversion strategy. So the hypothesis for this strategy is that any stock which is a decent stock, obviously you can't rely on stocks that have just launched and you don't know when they will fall, but a stock with decent market valuation. So the hypothesis is that it will always go to the mean value of its day of launch, and or whatever the timeline that you are taking. Suppose you are taking in last 180 days, so whatever it would be the mean value, the stock will return to that value during that time. So suppose if you are considering 150 days of timeline for a certain stock A, and the initial price was 100 rupees, and at present the price of the stock is 150 rupees. If you take the median of that price or mean of that price, then it's very likely that the stock will go back to that value. So that's why based on this, people long and short stocks. And so this might think like very obvious to people, and I have tried it as well. So sometimes it gains you returns, but sometimes it obviously causes you loss, and then people question the quant community that, hey, this doesn't work. But we never prepare a strategy just based on one particular strategy, because the more strategies you are using, the more selective stocks you are trading, and the more risk component is being reduced. So apart from considering mean reversion, there are few more hypotheses that are like pair trading. So pair trading is essentially you consider and plot kth nearest neighbor kind of AI model or whatever. You can use Python as well, and then what it does, it will tell you which stocks are correlated, be it positively correlated or negatively correlated. So suppose for in Indian context, I think I'm not exactly sure. I did this kind of practice as a practice thing for me, but I think these two stocks are negatively correlated. I think it's IOCL and ONGC. I think these, I'm not sure, but yeah, you can plot it on the graph and then you can find for yourself. So these stocks are negatively correlated. A negatively correlated stock will always inform you and would be very good strategy for you, because suppose if IOCL is going up and yet the price for ONGC is still up, but you know for sure that since they are negatively correlated, it will fall down, so you can short that stock. Similarly, if ONGC is up, then you can obviously short down the other IOCL company. So if you bring these two strategies together, then they work very good. Now, so in our work, we use this platform called WorldQuant Brain. So we don't necessarily code. We have all the data available and all the operators and these kind of things we have. We just have to formulate the mathematical expression, that in a fast expression language, which is essentially like TS rank, TS average, then group neutralization, all these things. So what a neutralization does to your strategy is something like, suppose you want to only consider stocks in a particular sub-industry, right? If you want to only trade the metal industry, then you can group neutralize that to a metal sub-industry group. And suppose you want to neutralize your strategy based on particular country or particular time, so you can do that as well. So these things help you draw down the risk and bring it down. So the more chances you have, the more likely you are to make money. So I think these are the major ideas. I think there are a few more like seasonality. So suppose some stocks like if there is a winter clothing brand, I'm not saying that this stock is present in the tradable universe, but I'm just giving a hypothesis. So suppose if a company is there which only sells something like cold clothes, so obviously their profits would be higher in the winter season, and then their stock will trade higher. So you can long the stock right before that, and you can short right after that. So trade seasonality is also something that we do consider while trading. And I think that is all. There are multiple quant models like binomial pricing model, and then say CAPM, and obviously the Black-Scholes options pricing model. So we'll talk about them in the upcoming videos if I do get a chance to speak about it. But yeah, I think that's enough of information overload as of today. So thank you for watching the video.